Jeff, Zach, thanks for joining me.
Hey,
Hey,
Steve.
Steve.
Hey, we're talking today about Wall Street valuations, showing that residential homes may be overpriced here. And yeah, at the end of the video, I think we'll give a few tips in terms of multifamily investing with respect to that. But when we're taking a look at stock market valuations, single shares of single family landlords, invitation homes, and American homes for rent, for instance, are trading at 35 to 20% discounts to their net asset values. Um, basically, the public market is pricing those valuations well below than what they're trading hands for privately in open market transaction. Share prices are signaling that single family home prices are too high. And, right now, the judgment of the market is it's not going to be sustainable. And that's having one impact of getting larger players looking to actually build new product, construct and try to be able to get that for cheaper rather than actually building at buying at current valuations. Some of you guys' initial thoughts on that?
Wait, so hold on a second. So the guys who've been buying all the single family homes at a premium are now telling us and telling everybody else that stop buying stuff at the premiums because we want to continue buying crap and you're screwing it up for us. So stop buying stuff. Good idea. Like,
Yeah, they want at a discount. Yeah, absolutely.
yeah,
I don't
it's a
think it's
joke.
news to anybody because we've all known home prices are too high and they've been too high for a while. It seemed artificially so. Um, but I like that you had the differentiation between public and private buyers. Private buyers are still paying a premium because it's their homes. It's not an investment. And
Right?
that gives me some solace in that article because I started thinking, crap, my house is going to be worthless now. Who wants to watch 35% of their value just go up overnight? So thanks for that, Steve. I'm going to lose a couple hours of sleep tonight. But publicly, it kind of makes sense because Jeff's right. Everyone's been buying for so long at a premium, and now those premiums just keep going up and up and up, and people kept paying them because they had to deploy capital, not because there was
These
value there.
people keep paying them.
These people, exactly. Hedge funds, private equity, Wall Street, deep pockets, foreign interests, REITs. You could go down a whole list, and it's just is a bad game of musical chairs. They're like, oops, someone started taking some of the chairs away.
Mhm. Or,
So
or oops, I don't want to buy it for what I've been buying it for because I'm not getting the returns I need. Let me put this article out there so people will lose value overnight. It's just stupid.
Well, one thing I will tell you is that what I think it tells you is where the safety net is. Like if something horrible would happen, you hit a bad recession, how far are values going to have to go before the big institutional players start coming in and buying them as bargains? And what that's telling you is you could look, nationally at like maybe a quarter of a drop before you saw, players come in sizable amounts looking at as bargains and deploying capital. Doesn't mean you're going to get that drop. Because what we've got, I mean, this is the other interesting thing. We got a housing shortage. There's not enough product out there. There's not enough houses out there. And then, and this is, I think, where it gets into an investment strategy we're pursuing is construction costs, labor costs, materials costs. They've gone up. So building new stock isn't exactly cheap. And then it really creates, I think, some opportunities we're looking at, especially when you look at kind of those mid or lower levels in the market where there's not enough stock. And it's also, to some degree, prohibitively expensive to build it new in terms of what you're going to get per square foot when you finish it. So I would say that that's an opportunity we see in multifamily.
well, look, that's kind of one of those tuning in
Yeah.
things is you're right. If you are at the don't call it low income, but if you're at workforce housing, that's where you need to be in the southeastern region where there's migration. So I mean, it's not that big of a surprise to anybody, but the truth is you're seeing rent still appreciate, you're seeing value still appreciate. You can still buy things at a reasonable cost and still make money on them. But the one thing this article doesn't say, and I'd love to see, is what did they buy the stuff for? So what did they buy it for what did they sell it for? They said they took a 35% loss, but if they made 200% on it, they still made what, 150%? And they're not really hurting that much. So I mean,
Well, it indicates that the average American home value is at roughly a 4% cap rate. And they need to buy at a 5%, 5 to 4, or I'm sorry, 5 to 6% cap rate for it to make sense for their return on investment. I mean, I don't know what that actually equivocates to in dollars, because you don't know, but that's just for the big investors. To me, this is social engineering side of media, from, hey, let's throw an article out there that scares people. Maybe that causes the market to change a little bit. And this is more scare tactic to me, and clickbait than actual real value of knowledge.
I would also say that sometimes journalists write these stories and they don't fully understand what they're talking about. I mean, to get
Steve, don't go there.
to get a little wonkish here just for a moment, one of the things you're looking at is you have a higher inflation rate, right? So what did bonds do for that? They adjusted to giving you a higher rate, higher interest rate. So you can now get your T-bills, your CDs, your bonds. You can get higher yield from them. Okay, so if you're buying a house to rent, what do you have to do in order for that house to now adjust to this higher environment? Well, it needs to kick out a higher yield. Now it needs to either do that with higher rents or with a lower purchase price of the asset. So I think partly what's just going on here is the residential market, it's private market, it doesn't adjust as quickly. So it hasn't adjusted to giving out the yields that are as competitive with other securities. And that's, and again, kind of wonkish, but ultimately I'm going back to, hey, we like workforce housing. We like mid. We see some opportunities there. And
Well,
maybe some of the
look,
higher end residential, not so much.
I agree, but you gave another secret point as well. Is sellers may come out and advertise one price, but they're trying to reach for that price. The secret there is the fact that everyone knows interest rates are high and that there are stuff that are trading hands at discounts like this. So you can go in and you don't have to pay asking or get into bidding wars. You can actually come in below asking price today and get better values. And not a lot of people know that.
Okay, well,
Yeah.
we're going to be talking about residential, multifam for quite a bit. Thanks a lot for the insights, guys. Give us a thumbs up if you enjoyed. Subscribe if you have not. Visit the website selectfincap.com. Get in on our exclusive newsletter that offers opportunities at commercial real estate investment opportunities as well as free news on the real estate space. Thanks a lot again, guys.
Thank you,
Thanks, Steve.
Steve.